Welcome, everybody. If you're a working professional in your 30s and 40s or even 50s, you're earning well, but still feel unsure about whether your money is working hard for you. Maybe you've thought, am I doing enough to retire comfortably? What's a right investment mix? And why does everything feel so confusing? Then this webinar is for you. Here's what I've learned. Most professionals, especially engineers, tech workers, doctors, don't have a clear written investment plan. And that's not because they're not smart, it's because nobody ever taught them how to build one. Instead, people often chase stock tips or hot trends. They move money between real estate, crypto, mutual funds without a framework. They feel anxious when markets fall, or worse, do nothing out of fear. And I get it, I've been there myself. But here's what has changed the game for me. I started focusing on education before execution. And I have created a simple investment calculator to model my goals, allocations, and progress. And which this is something that I'm going to share with the Telegram community today. So here is my investment calculator. And by the way, before I walk through the investment calculator, let me just show you what they all mean. So very first part of the calculator. So calculator has multiple tabs. The first tab is a disclaimer. So basically shows that this is for educational purposes. The second tab talks about rainy day savings. So how do you build a rainy day savings? The third tab has three different sections in it. One represents short term, one represents mid-term, and third represents the long term. So people may have different plans, right? Like short term could be that I'm about to get married. Mid-term could be that I need to save for my kids' education or a down payment. And the long term could be retirement. So all that is modeled here. And the third tab outlines different multiple buckets of investments a person may have. So for instance, somebody reached out to me and they said, Amit, I have some money in private equity, real estate, a debt fund, stocks. How do I model all that? And I want to retire at a certain age. How do I figure that out? So this specific tab is going to help with that. So let me start working out the rainy day savings, and then I'm going to go through the scenarios. So rainy day savings essentially means that you need to save for emergencies. And the emergencies essentially are what's going to happen, suddenly, let's say you get laid off or you suddenly need a car. What are you going to do? So this is how you work it out. So let's say a person's monthly expense is $6,000. So or $5,000. So let me put $5,000 here. And they want to have a safety net for 6 months. So in here, put 6 months. By the way, anything in yellow is typically what you should be editing. Nothing, you shouldn't be editing anything else because it's going to mess up formulas. So monthly expense 5,000, safety net 6 months. So notice it says total rainy day savings you need is $30,000. Now, how much amount you currently have? So maybe you already have something saved up. So let's say you already have $12,000 saved up. So I'm going to put 12,000 here. So that means automatically it says additional money needed is 18,000. So now, how do you build that safety net? So what you do is in your monthly contributions, you're going to say that maybe I'm comfortable saving $600 towards this every month. So you put 600, and let's say instead of putting in savings, you're going to put it in some kind of an investment portfolio. It could even be an ETF that invests in bonds, or there are a whole bunch of other instruments that your banks will have. If you call up your banks, you can get that information. Or if you watch my course number 1, which is freely available at Informed and Invested, there are some investment instruments I even talk about that you can use for short-term investments, such as a rainy day saving. And the advantage of these kinds of instruments is that you can put money in and take out the money fairly easily. So cash is very liquid. So let's say annual interest rate in something of this nature is 4.5%. So if I put that, it shows the monthly compounding is 0.37%. So that is calculated automatically. So based on these scenarios, notice you automatically certain things start to happen. And here, this represents months. Next column represents principals and how much you're additionally adding. So it shows that you will have a rainy day saving automatically. I mean, this number comes up. So you'll have a rainy day saving by the time 27th month rolls around. And if you're comfortable with that, you just keep on doing it and you'll be good. And if you think that, no, this is too long, I want my rainy day savings sooner, then you can play around with the variables. You can say, okay, maybe instead of 600, what if I increase this to 750? So insert that, and then you can say, okay, great. You can have your rainy day saving in 22 months, which is a little less than 2 years. And so on and so forth. What if you were to say, maybe I have an investment vehicle available that gives me a little more interest? So let's say instead of 4.5%, it gives you 6%. So you go 6%, and that also says, well, it's still going to be 22 months. So that's how you work this calculator out. Next is the second tab, which shows you short-term, midterm, and long-term. And this is where I'm going to work out the scenario. So dual income couple, college plus retirement, college, they have $100,000, three kids, ages 11, 8, and 5. Yearly education cost, they want $50,000 per child. Retirement, they want to retire with $200,000 of income, and they want to fully fund their kids in 8 years, starting 8 years because their oldest is 11. And by the time they're 65, they want to have $150,000. So 150 or 200. So we'll check that out. So current age is, we'll start with the same. Let's say the current age is 42. And they want to have a midterm goal. So college, they have $100,000. So I'm going to put $100,000 in midterm. So $100,000 they currently have right here. Okay. And I'm not going to put anything in requirements at this time. I'll work that out in a bit. Monthly contribution, they are saying that they will invest, let's say, $600 every month, and they'll keep doing that. So I also have another column, another cell here that adds up what is the total monthly contribution you're having towards your different investments. So short-term, mid-term, long-term. So this way you can tell that do you actually have this much money available. And let's say the contribution increase, I'm going to leave that to 0 for now. Expected compounded average growth rate. So let's say they're going to put it in the S&P 500 for now. So they're going to get 10%, and they're going to invest this money for midterm for they're going to keep investing until their youngest child, who's 5, is going to enter university. So if he's 5 and that kid is going to enter university at the age of 18, so that's 13 years. So they're going to keep investing for 13 years. But they'll also need to keep investing till the youngest one goes to finishes college, right? So 13 plus 4 is 17. So they're going to keep investing for 17 years. So I'm going to put that right here. So notice what happens. With a $7,200 or $6,000 monthly, which is $7,200 yearly, the $100,000 starts to grow, and it's also growing at a 10% CAGR. And notice that grows to $797,000 by the time their youngest child gets out of university. And now I'm going to say that let's start adding requirements that if they carry on like this and the S&P behaves with 10% CAGR, what is this instrument going to look like? And do they have enough? So at 8-year mark, which is when their first kid is going to be 18, so which is actually 7-year mark. Let's say they're going to require $50,000 to put the first kid to college. So that's $50,000 come off, or I'm going to put $50,000 in requirement. And that kid is going to continue second year as well. But third year, their second child is also now ready to go to university. So now $50,000 is going to turn into $100,000. So notice my principals are going to start reducing. So not $100,000. And second year as well, or next year as well, $100,000. By the time this kid finishes the second year, the first child is done their education. So now this year is just going to be $50,000. And notice the principal is starting to now turn negative. And now the third kid is also now ready to go to school. So this kid is going to charge $50,000 extra, which is now $100,000. And 1, 2, 3, 4. So by this time, the second kid is done education, university, and now the third kid is going to carry on in university. So there and there. So now you'll notice that this couple is going to be in a hole for $204,000 if they continue with this. So now what they need to do is now they need to think about how they increase some variables so they can do better than this. So one variable could be they can say, all right, what if I were to increase my contribution every year by a certain percent? So let's say 3%, because 3% is a typical annual inflation. So let's say they say, all right, Amit, every year I'm going to add 3% more because that's a kind of increment I'm going to get in my company. So they increase by 3%, but notice, although the addition amount has gone up, but they still end up being in a hole, not for 200 some thousand dollars, but now this time $190,000 or $171,000. So now maybe they have to increase their monthly contribution. So instead of 600, maybe they have to increase it, start by 700 a month. Does that work? That doesn't work. What if it's $1,000 a month? Yeah, $1,000 starts to work pretty well. And you notice that they'll only have a loss of $14,000 in their 14th year. Sorry, did anybody have a question? Okay, no, but please put your phone on my your microphone on mute. Now, same person. Now let's talk about their retirement. So this person now wants to retire with $200,000, $150 to $200,000 by the time they turn 65. So for that, we're going to look at the long-term planning. Current age 42, and their retirement age is 65. So here I'm going to put 65. And notice when you do this, you automatically get 65 written here. So what is the initial investment? So they currently have in their yearly, in their retirement plan, they currently have $150,000. So I'm going to put $150,000 starting. And let's say their monthly investment is another, I'll just put $600. So notice that $600 comes in, and I'm going to say how many years are they going to invest for? So if they going to retire at this time, the way you check is this is 65, and notice here this says 23. That means for 23 years they're going to keep investing before they retire. So in the years to invest, I'm just going to put 23. So there you go. You have $150,000 with $7,200 additional. There's no compounded annual growth rate that has been added yet, but this is just straight addition. So it's as if they were putting money in the savings account. So it goes from 150, then 157, 164. So by the time they are about to retire, and if they were not to invest this money, they will be sitting at $315,000. Now, what if they were to start investing this money? So for that, I'm going to put right here in expected average compounded annual growth rate. Let me put 10%, assuming that they invest money in S&P 500. Now notice that by the time they retire, that $300-some thousand has now grown to $1.9 million. Why? Because not only are they continuing to deposit $7,200 extra, but now this money is invested in the S&P 500, assuming it continues to give 10% compounded CAGR, then that's what they come to. Now, what if they say that because every year they get 3% increment to match with inflation, that every year, instead of just putting $600 per month, they also are able to increase that by 3% a year. So here in contribution increase per year, I'm going to put 3% and hit enter. So instead of just investing 7,200 that you did at the very beginning, it's by the time you're about to retire, you're now investing 14,000 a year. And your portfolio has now grown to $2.06 million. Now, let's see that if you were to retire with $150,000, are you actually able to do it? So for that, I'm going to put pension amount in this area, which is the row 27. I'm going to put $150,000. Notice now, in the pension column, $150,000 gets written. But at the same time, the portfolio carries on increasing. You'll also notice that there is no more addition happening beyond the retirement age, because now you're starting to withdraw cash from your portfolio. And you're doing just fine. So $150,000, your portfolio continues to increase and you're doing fine. What if you were to say that, Amit, at the time of retirement, inflation is still going to carry on at 3%. Can I update this such that there is a 3% increment? Of course you can. So I have added another section here, which says pension increase per year. Let's add 3%. And you notice that 154 now starts to increase. So 154 in first year, next year 159, next year 163. Assuming the growth continues with 10%, you're even fine with this amount. You can even say that, all right, well, notice if I scroll down, by the time you are 108, you will have eaten up all your money. So if you are planning to live that long, then of course you may have to lower the amount of money you take out. But if you think that you might be able to consume all your money and be okay by the time you're 107 years old, then this kind of withdrawal seems to make sense. And you can play around these variables as well. What if you were to say, Amit, I want to withdraw instead of 150, I want to take out $200,000. So put $200,000 here. And notice that by the time you are going to hit 84 years of age, you'll run out of money. So in that case, maybe you need to do something. So maybe instead of an expected CAGR of 10%, maybe you say, Amit, I'm going to learn long-term investing, value investing with you. Maybe I can do a little better. So instead of 10%, maybe I can do 12%. So if you put 12% here, you notice that, that problem goes away. And by the time you are 115, your portfolio will be sitting at $207 million. So you notice how small variable changes can have such an impact. I'll make this calculator available to our group, our Telegram group, but this goes to show that you can actually start inserting different variables inside these areas and start to craft a strategy that is applicable to you based on your specific circumstance. Now, another scenario that was delivered to me through one of the members of the Telegram community was the following. This was through a person who said, Amit, I have a whole bunch of investments. I'm in mid 50s. I have some money in stocks, some money in bonds, some money in the stocks being domestic stocks, and he also has some money in foreign stocks. He's got money in private credit, and he wants to start slowing down in about 7 years. So let's work this out. Again, I'm going to just start deleting a few things because I had worked out some numbers for this person, but I'm going to do them right in front of you so you guys can all see this. So again, what you want to do is you want to edit only the fields that are, or columns and rows and cells that are in yellow. So this person's age right here is 55. So I'll put 55. The first set of columns show you a sum of all different kinds of investments people will have. So if you are such a person who has multiple different investments, then this is kind of what you're going to want to do. So this person's age is 55. So put your age here. So 55 in cell B4. Then the first investment here, just write out what the different investments are. So let's say the person's first investments are bonds. And what is expected return? I don't know in this case, the person hasn't told me what kind of returns they're getting, but I'll just take some assumptions. So I'll just say this person gets 4.5% compounded, 4.5% every year from bonds. And this person has, let's say in bonds, $300,000 and maybe adds nothing to it. So it just has $300,000 and it just grows every year. And we're going to figure out after 7 years what to do. Then let's say this person has stocks as well. So in here, I'm going to put stocks. And how much is he getting out of stocks? Let's say the person gets 10%, which is what S&P 500 has given historically. Again, we don't know whether it's going to continue giving, but let's say that's what we're going to put this for our estimation purposes. And how much money does this person have in domestic stocks? Let's say about $540,000. Okay. The other kind of investment he has is, let's say it has foreign stocks. So foreign stocks. And let's say the person gets, I don't know, 9% out of that. And how much does the person have what is the principal value of that? Let's say it's another $250,000. Then the person also has some money in private credit. So put private credit here. And let's say the private credit is very nice and gives them 12%. And how much money does the person have in there? Because it's a slightly higher risk, they'll say, I'm at $150,000. So put that 150K here and hit enter. Now you notice on the left side, what you start seeing is a total portfolio value. So in year 1 or year 0, currently, the person has a net worth just from these liquid assets or investment assets of 1.24 million. Certainly, this doesn't take into consideration any kind of real estate it has, but these are the liquid assets. So if he has real estate as well, just put some numbers there and figure out the growth. I recognize when you have money in investment, you also, and if it's on mortgage, your mortgage value is going to be going down. The property value is going to be increasing. So come up with some kind of sensible growth figure based on how your equity is actually going in that. So then you add that in the last column and you'll also start to get that kind of an estimate, total estimates. So first year, 1.2 million. Next year, the money goes, the portfolio goes to 1.3, 1.4, then 1.5, and so on and so forth. Now, let's say this person also has some kind of additions. So in this specific calculator, you have to go every year and add in how much money you're adding. Whereas in the previous tab, information is controlled from the very left side of the tab. But here, let's say the person adds every year $10,000 extra. So 10,000 in the stock portfolio I'm going to add, and it goes like this. And if you want to put a formula, you can even do that. You can say maybe he increases it by 2% every year. So just say equal to cell above times 1.02, hit enter, and then you just do control down, and then automatically that money is going to come in, and then the portfolio value is going to increase accordingly. Let's say the same thing in stocks. A person puts in another $5,000 every month. So here you go, 5,000, just keep adding. Now, on the left side, you'll also notice that I have a sum of how much you're adding and a sum of how much you're withdrawing as well. So this can give you an idea that if you're putting total $15,000 extra a month, a year, do you actually have that much money? So do that kind of an analysis as well. So now this person wants to retire or start winding down in 7 years. What that means, I don't really know, but let's assume that the person wants to take out $150,000 after 7 years every single year from these investments. Can the person do it? So how do you figure that out? Well, this is what you do. What you're going to do is you're going to start plucking a certain amount of money. And somebody else in our group had also asked us, what is a tax efficient way? Again, I'm not a tax attorney or an accountant. You got to ask your own accountants these kinds of questions. But let's think logically, right? So if there are certain kind of investment vehicles that you have that are treated differently from a tax point of view, then you want to maybe plan out that if I take a certain amount, what is going to minimize my tax burden? So these kinds of numbers are available in government's website. So take those numbers and do your own math. But let's do some assessment or just simple thought exercise here. So let's say by the time 7 year rolls around, so which is right here, the person wants to take out $150,000. So how do you take out $150,000? Maybe in bonds, he's going to take out every year from bonds, he's going to take out $20,000. So in the withdrawal section, put 20K. Because he has $408,000, this is going to be okay. So I'm going to just maybe put it down like this, $20,000. And notice that because the portfolio continues to grow, that means it's probably okay that he can carry on taking this amount. I mean, it goes down very slightly. So 401 goes down to 399. So anyways, available for some adjustment, or maybe it's okay because he'll say, I have so much money that it's perfectly okay for me to take out this amount. So again, work this out based on your specific example. Next is stocks. This person has $1.1 million by the time 7th year rolls around. So maybe he says, I'm not going to keep investing after 7 years, so I'm going to stop this. So that's perfectly fine. Maybe stops in sixth year. So by the time 7th year rolls around, he's got $1.1 million in this domestic stocks portfolio. So he says, all right, maybe I'll take out another $40,000 from here. And in these kinds of portfolios, you're only going to be taxed on capital gains, right? Not on how much money you have. So capital gains is what you're going to be taxed on. So take this $40,000 and notice that the investment portfolio continues to grow. So this 40,000 is fully logical. On the left side, you'll notice that total amount is now turning to 60K. So foreign stocks as well. The guy's got $530,000. So maybe he's going to take out $20,000 from here. And he's going to stop investing after the 7th year. So $20,000, let's bring it down. What is happening to the portfolio? The portfolio carries on growing. So 503 to 528. So that means it may be able to take out a little more. Again, this assumes that the market continues to grow on those averages, right? Some years may not, some years it may grow more. So at that time, when the time comes, you'll have to maybe adjust. Or remember what I was saying was in your investment policy statement, you could say that by the time I come close to retirement or I have retired, maybe I'll have a split. Maybe I'll increase my bond portfolio. So that's how you can plan out. In private credit, this person's got $331,000. So maybe he's going to take out another 20K from here. So let's do that. And notice now his yearly withdrawals have now reached $100,000 while the portfolio continues to grow. So that's perfectly fine. Then he's got no other investments. So he cannot take out more than 100K. So in order to take out more than 100K, now he's got to play out with the numbers. So because the stock portfolio continues to grow, maybe he'll say, can I make it $50,000? So if I go like that, yeah, portfolio continues to grow. So that's perfectly fine. In this case, portfolio keeps going down. So you say, maybe this is okay or not okay. Depends on this person's situation. In this case, in the foreign stocks, maybe he can take out a little more. Put $30,000. Check that out. And the portfolio on the left continues to grow. This has now come to $120,000. And here, can he take out 30,000 here? Let's see. Down. Does the portfolio continue to increase? Yeah, portfolio continue to increase. So he has now come to $130,000. Now he may say, all right, well, instead of investing $10,000 every year, which is little less than $1,000 a month, maybe I can grow this. Maybe I can have $12,000 every month or every year. Every month I can invest toward this portfolio. So if you do that, then maybe instead of 50,000, he can take out $70,000. So put $70,000 here. And you notice the portfolio still continues to increase. And if you keep on doing this for a longer amount of time, you'll notice that for this specific individual, an ability to withdraw $150,000 is a possibility based on these scenarios. So again, like I said, I'm going to make this available to you all. Please work out using your own specific scenarios and see how that helps you.